Informed Choice Radio, episode 192. Lars Kroijer, Investing Demystified.
It's historically been a huge tendency for people to overinvest in their home markets. Now, that's a mistake for a couple of reasons. One of which is you're not getting diversifying benefits that you would in a world equity index tracker. But also, you're actually adding concentration risk to your overall economic life. If you can't beat the markets, go buy a cheap world equity index tracker. What I'm saying is not that markets can't be beaten. I'm saying that each investor should make clear to themselves whether they can or not.
From Sundial House Studios in Cranley, welcome to Informed Choice Radio. This is the podcast all about achieving your financial goals in life. Here's your host, Martin Bamford.
My guest on the podcast today is Lars Kroijer, former hedge fund manager and author of Investing Demystified. Lars was the chief investment officer of Holte Capital, a London-based market-neutral special situations hedge fund, which he founded in 2002 before returning external capital in the spring of 2008. Prior to establishing Holte Capital, Lars served in the London office of HBK Investments, focusing on special situations investing and event-driven arbitrage. He's also worked at SC Fundamental, a value-focused hedge fund in New York. Lars graduated Magna cum laude from Harvard University with a degree in economics and also received an MBA from Harvard Business School. His first book was Money Mavericks, Confessions of a Hedge Fund Manager. He's also the author of Investing Demystified, How to Invest Without Speculation and Sleepless Nights, which has a second edition out next month from FT Publishing. In this episode of Informed Choice Radio, I speak to Lars about what makes investing so complex, why a low-cost approach to investing works well for most investors, the lowest risk investment available in the current economic environment, the impact tax and liquidity has on portfolio returns, and much more. You can find the show notes, full transcript, and useful links for this episode at icradio.co.uk. If you enjoy listening, and I hope you do, please do let me know on Twitter at Martin Bamford. Please also say hello to Lars on Twitter, where you can find him at Lars Kroijer. That's LarsKroijer. I'd also massively appreciate your review of this podcast on iTunes. Just visit icradio.co.uk/iTunes or look for Informed Choice Radio on iTunes to leave us a review, and we will of course read it out in a future episode. Welcome to Investing Demystified with Lars Kroijer in episode 192 of Informed Choice Radio. So Lars, could you start by telling our listeners a little bit about you and about your background?
Sure. So I'm originally Danish, and well, I guess I'm still Danish, right? That doesn't go away. But I haven't lived in Denmark since 1990s. I lived in the U.S. for 10 years, did all my university there, and I joined a hedge fund in New York in '99, and then soon after that moved to London, and in London set up my own hedge fund in 2002. And did that for 6 years until incredibly fortuitously right before the crash, I sold/unwound my fund. And since then, I've written a couple of books about finance, and I still sit on the board of a number of hedge funds, 5 to be exact. And I'm also doing I call it a kind of charity, which is something called Allied Crowds, where we try to get more capital flows to the least developed countries in the world. So that's the 30-second resume-free background, I guess.
Fantastic. And you say it was fortuitous that you stepped away from a hedge fund management shortly before the financial crash. Was it luck, or did you see something coming, or was there sort of signs in the market?
No, I didn't. Yeah, it was perhaps luck is the wrong word, because it had more to do with sort of where I was in my life, and I'd made some money, and I had absolutely stopped loving what I was doing, and so it's more to do with those kind of things than me seeing what was happening in the market and wanting to step away from that. So from a financial perspective, it was luck. Timing wise, it was luck. In fact, if I had seen it coming, I would have shorted everything in sight, right, and made a lot of money for my investors. And that wasn't actually because of the kind of investing we did. We were very focused on market neutrality in our investments. So I don't think it would have hurt us that badly, the crash, although that's easy to say in hindsight, obviously. But if we had stayed the course with what we're doing, we wouldn't have done that badly, certainly compared to some of the people that were very exposed to the markets.
And you mentioned in your introduction you're the author of a couple of books. The first was Money Mavericks, Confessions of a Hedge Fund Manager. Your latest is Investing Demystified, How to Invest Without Speculation and Sleepless Nights. And I understand the second edition is coming out shortly. Can we start with the question then?
I'm being harassed by my publisher.
I'm pleased to hear it. That's what they're there for.
It's like having homework, I tell you. It really is, actually. They're like, oh, did you do that thing you said you were going to do? But yeah, no, that's coming out, I think, at the end of April.
And the subject is about demystifying investment. So what is it that makes investing so complex?
Yeah, I wrote just to take a step back, the first book was about my experience of starting and running a hedge fund. And I thought, I originally wanted to write that because I thought it was an industry, so much had been said and written about by people that weren't really from the industry, and it was all very incredibly sort of sensationalist. It was either about people making millions and driving Ferraris, or people swindling other people out of billions of dollars. And the industry I had seen was much more mundane, but you didn't have any of that, but it wasn't uninteresting. So I just thought I was in a position to tell that story. So that was the first book. The second book came about because, actually for a hedge fund manager, a little funny, but my background was I studied a lot of portfolio theory. And I thought I wanted to write a book about how someone like my mother should invest her money. And she should clearly stay very far away from the whole financial circus and, frankly, hedge fund managers like myself. But why should she do that, and what else should she do? And that was what I was trying to do with Investing Demystified. And the whole point of the book, or at least the premise of the book, is that as the very, very first thing as an investor, you have to make clear with yourself whether you have any realistic chance of beating the markets. Right? So can you beat the markets through active security selection? Or another way of beating the market is to find people that can do so for you. And basically I argue, and I actually feel very strongly about this, I argue that it's overwhelmingly unlikely that you can. So first thing, make clear with yourself whether you can beat the markets or not. And if you convince yourself that you can't, what should you then do? That's essentially what the book is about.
And that, I guess, brings us on to the subject of low-cost investing and index trackers and things. It's very much in vogue at the moment. Even Warren Buffett was recommending it to investors in his latest letter to shareholders. Why does a low-cost approach to investing work best for most investors?
Well, so perhaps think that it's not low cost for low cost's sake. It's low cost because the best way to invest your money, if you can't beat the markets, is index trackers. And keep in mind, what does an index tracker do? It tracks almost blindly an index of securities. And we can talk about how those indices are created. But think of in the UK, tracking the UK stock market. Now, a monkey can't do it, but a computer certainly can. And as a result, it's very, very cheap. So in other words, if someone comes and says, someone wearing a fancy suit tells you, look, I can beat the markets for you, and you come to the realization that I don't know if you can, but on average, you're not going to be able to, then an index tracking investment is a better choice, and it's just very, very cheap. You pay like 0.1% per year to have your money managed, as opposed to an all-in cost of perhaps 2% a year. And over a long time, that's going to matter a huge deal to your savings. In fact, I have this example in the book where if you take someone who drives a train on the London Underground, who, let's say he on average makes £50,000 a year, and he puts 10% aside a year in savings, so just for argument's sake, say he puts it all in equities. Over the lifetime, between 26 and retirement, the amount of money that person will pay in an active fund as opposed to an index tracking fund is the same as the value of 7 Porsche cars. Right, so that's a pretty staggering amount of money over a lifetime that someone with a decent but not high-paying job pays to the financial industry. And the point is, he doesn't get better returns as a result. In fact, on average, he gets worse returns by the fees. Pretty much exactly, actually. And so, can that person beat the markets? Overwhelmingly likely not. And there's a huge financial incentive to to buying index tracking investments.
And you mentioned there that whilst it's a case of the index tracker buying the entire indices, and that's almost like a blind investment decision, there is some activity, some active selection taking place in terms of which indices you select. So how do investors make those choices? Because I don't think there's ever such a thing as entirely passive investing.
Well, okay, so my view on that is that you should only buy the World Equity Index Tracker. So there's historically been a huge tendency for people to overinvest in their home markets. So that means that you as a UK-based person would buy the FTSE Index Tracker. Now, that's a mistake for a couple of reasons, one of which is you're not getting diversifying benefits that you would in a World Equity Index Tracker. But also, you're actually adding concentration risk to your overall economic life. I mean, not knowing much about you, but you're clearly based in the UK, your job is in the UK, your pension is in the UK, your house, if you have one, is in the UK. You already have plenty of UK exposure. So if anything, you should actually de-invest from the UK markets. But you should, failing that, you should go as broad and as cheap as you can, and that's the World Equity Index Tracker. And that is actually the most passive thing, because implicitly in that, you're saying that I can't allocate. And again, we're just talking equity markets, we're talking about other security classes, but you're saying I can't allocate money differently or better to how the, $70 trillion world equity markets have done. And that's as passive as you're going to get in the equity markets. So that's what I'm saying you should do, or anyone should do. If you can't beat the markets, go buy a cheap World Equity Index Tracker.
When's the right time then to invest in a hedge fund like the one you used to manage? Because obviously you were successful as a hedge fund manager, your investors got good results. Where's that line drawn between investors who should go for a low-cost passive approach and those that should put their faith in professional fund managers and hope to get better returns?
Yeah, it's a good. Sometimes kids can ask why. Tell me why you're not a hypocrite. So it's quite important actually, right? Because what I'm saying is not that markets can't be beaten. I'm saying that each investor should make clear to themselves whether they can or not. Right? And the overwhelming likely answers that they cannot. They cannot do it so themselves, and they can't pick someone to do so for them. So if you say, well, should someone invest in a hedge fund? Well, if you so let's say I come along and 10 other Larses come along and pitch you these great investment ideas and these great fund management companies, and you're taking the view that I can pick which ones are going to outperform. It's an amazingly valuable skill if you have it, but that's absolutely something you should do. If you have the skills of a Warren Buffett to pick the right securities or pick the right hedge funds, the underlying fund managers, you should absolutely do so and at any point in time. And by the way, if you do, please get in touch, because that's a very, very valuable skill. But I will tell you, I've met a lot of people that think they can beat the markets, and I think I've met far, far fewer that I think can beat the market. It's not an easy thing to do. And I think I thought it was incredibly, incredibly hard. And we had access to the best information, the brightest minds, the best sources, the best technology, the conferences, anything you can imagine, systems, algorithms, and so forth. And it was incredibly hard for us. So imagine you're someone sitting in your boxer shorts at home with an E-Trade account. It's going to be tough. So just be very clear with yourself whether you actually can. And I think there's a huge element that a lot of people are guilty of selective memory. We tend to remember our winners. Sometimes it's just nicer to remember when we, bought Apple before it went up than when we bought Enron before it went bust. Kind of thing, right? That's I think something we're all very guilty of.
How can investors go about constructing a portfolio which performs well? You said then a moment ago, it's a simple case of buying the World Equity Index Tracker for most investors. But is there a greater need for diversification, maybe complexity within a portfolio to make sure it delivers good results? The risk of oversimplifying, if you can't beat the market, you can create, in my view, a portfolio that's better than 99% of portfolios out there, which is that, let's say you have two securities. One is a Vanguard investment or an iShares investment in the World Equity Index Tracker. By the way, be very, very
thoughtful about taxes, because that's one of the things that really can screw all of this up. Right? But so one thing is that. So that's pot A is your equity. Pot B is, let's say you're a sterling-based investor. So in the UK, you buy UK government bonds in a time horizon that roughly matches your investment horizon. Right? So if it's for your retirement in 20 years, you look for roughly 20-year maturity government bonds. So that's your pot B. Now you combine pot A, so the equity, and pot B, the bonds, in the proportions that suit your risk profile. So if you want a lot of risk, you do more equity. If you want no risk, you do a lot of government bonds. And so sort of anywhere from 100% to 0% of either, right? That's it. You have an extremely powerful portfolio, extremely cheaply constructed, suitable to your risk levels. And if you just that, and by the way, keep in mind, I have not sold you anything that costs more than 0.1% a year. Well, I'm not even the one selling it to you, but it's that, just do that. If you start with that and you go to someone and say, do I need more complexity? They have to have a really good reason for you to add that complexity. I think there's arguments around also investing in broad indices of corporate bonds or broad indices of other types of government bonds, but that's really on the margin. You don't need, unless you have an extraordinarily compelling reason why you can beat the market, you don't need commodities, you don't need more real estate than you already have, you don't need private equity or hedge funds or anything like that. It's expensive. It's not clear that you will outperform by buying it. So no, I don't think you need to be. There's obviously a lot of people that have huge vested interest in selling you very, very complex things and then selling you great pieces of advice on how to navigate what they've just sold you. But in reality, most likely you don't need it.
In terms of the risk level then, you mentioned there more in equities if you're taking greater risks, need to take greater risks. What steps would investors take to determine what the right split was between the equity proportion and the gilt proportion? Yeah,
it's a question I get asked far too little, because this is probably the area where I would most say an advisor is a helpful thing to have. Because it really depends on who you are, what your personal circumstances are, even down to like, how do you feel about risk? And if you invest in equity markets, you probably can reasonably expect to make 4-5% real returns a year. But you should also expect once in a while you lose half your money. Right? Are you ready for that? What would happen in your life when that happens? And so risk is something that's incredibly individual and something people need to think long and hard about. And it has to do with your time horizons, has to do with what would happen in your life if you lost half your money, kind of thing. Could you handle it? What would happen if you lost your job? This, by the way, coming back to the example before of investing in the UK, it's a great reason to not invest in the UK is this scenario where you lose your job at the same time and for the same reasons that the local equity market went down in value. And so you're actually and that's the same reason why getting a new job is hard. And that's the same reason why all of a sudden your educational background is not as helpful as it used to be, et cetera, et cetera. So you're taking massive correlation risk. And it's that correlation risk you should diversify away from. And you do that by investing in as broadly and cheaply as possible. By the way, I should say that I've made some YouTube videos about all this. Did I mention? I didn't mention that, did I? Where I just go through all these arguments, so you don't have to buy a book and just go check it out on YouTube. And I'm huge into this idea of correlation risk, and you're certainly avoiding it as much as you can by diversifying globally.
We're in an environment at the moment where interest rates are very low, gilt yields are very low, and there's very low prospect for return on most assets. What are the lowest risk investments that people can make in this current environment other than leaving money in cash? And is there such a thing as a risk-free investment?
No, there isn't. I mean, what you sort of think about, what is the lowest risk investment? What is that, right? And you'd immediately say, people used to say stuff like gold, but gold is extraordinarily volatile. Then they say property, but property values are extraordinarily volatile. And the lowest risk investment today is probably a government bond. If you are lucky enough that your investment currency is one where there's a highly, highly rated government bond, then that's it. So if you're a sterling-based investor, which I imagine most of your listeners are, then a short-term UK government bond is the lowest risk investment. Traditionally in academia and so forth, people always talked about sort of 3 months US Treasuries as the riskless investment. And it was never really riskless because, of course, the US government can go bust, but it's just pretty unlikely that it'll do that in a 3-month period. And so that's why it was deemed the riskless. But from the perspective of a UK investor, if you buy $100 3-month US Treasury, US government bond, you're pretty sure you're going to get your $100 back, but you don't know what that's worth in pound sterling. So from the perspective of a sterling investor, you should buy UK government bonds. Right? Does that make sense?
Absolutely. No, that makes sense to me.
I mean, because if you're in certain currencies, you don't have that choice.
Yeah.
Right. What is your riskless investment if you're in Brazilian real? Well, your Brazilian government bond are not low risk. I mean, there's a reason they yield high single-digit percentage returns even after inflation is still very high, right? So you don't have that choice of a super low-risk investment in your local currency. You mentioned, that's, of course, why in places like that, there's a far greater tendency to have sort of money in the mattress or in the bank or even having gold and things like that.
You mentioned a little earlier that tax can really derail investment progress. I know liquidity is another issue as well for investors. So how much of an impact does tax and liquidity have on your investment returns?
Well, so let me start with liquidity, because liquidity is not, I don't want to keep saying World Equity Index, but it is really true. Like, that's as liquid as they come, and as is your government bond. Liquidity is one of those things that people only think about when they don't have it, or at least that's my view. So imagine in my book I walk through an example of someone who has a £1,000 investment in Microsoft and a £1,000 investment in an illiquid small cap company, and liquidity dries up as a result of market shock, and that means that not only is your investment down in value, but you can't realize it. And so you only realize that when it hits the fan, right? When you can't get your money back. So liquidity is incredibly important and something people need to think long and hard about. Also, in the context of, well, what would happen if I can't access my money? I mean, there's probably never a time when that's good news, but there are times in your life where that's horrendous news. So that's liquidity. Think about it long and hard if you're making illiquid investments. Or investments that can become illiquid. On taxes, it's hard to generalize, right? Because it's so individual. But we're talking. Take the example going back to an index tracker versus a mutual fund or an active manager. The cost advantages is perhaps called 1.5% to 2% per year. Now that adds up to a ton of money over time, but that can also easily be dwarfed by tax disadvantages. So imagine an extremely unlikely scenario where you pay 25% tax if you buy an index tracker, but 0 if you buy an active manager. That's a pretty unrealistic example. But then it would make sense to buy, obviously, the active manager. So you do have to think this in the context of tax, which is, again, individual. And it's, again, an area where I think financial advisors can be very helpful. But the reality is it's very rarely the case that you can't buy cheap investment products tax efficiently. That's very rarely the case. Certainly in my native Denmark, there's some rule where low-cost ETFs get taxed in a different and disadvantageous way, which is just crazy because it's effectively a subsidy to the banks. But there are cases like that. But by and large, you're going to be able to make cost-efficient investments that are tax-efficient also.
And another thing, of course, which can derail investment performance is us as humans. So our behavior, and behavior is a real issue for investors. So to what extent does behavior influence investment returns?
Oh, a ton. I mean, I get goosebumps whenever I see these ads for these like trading platforms. They're sort of day trading, trade your way to become a millionaire, or buy stocks here and sell them there. The worst thing you can do is trade a lot. Don't trade a lot. If nothing else I've said makes any sense, then just don't trade a lot. Because that is the overwhelming reason why people lose money in the markets. Now, there are very few people that are incentivized to tell you that, right? Because the people whose trading platforms you're using, the advisors, the banks, the accountants, everyone's making money from your activity, except yourself. Right? So that's a very bad thing to do. There's also a tendency for people to do a lot of stuff when markets are bad. And just to hit that on the head, I'm not saying you should never do anything, but you should you should sort of take a step back and see, well, how has my overall economic life changed, and do I need to make longer term adjustments? That's very different from the kind of, I see Microsoft is down 10%, I must go buy it tomorrow. And I think in reality, you should trade so little that you're actually only trading your portfolio when you're taking money out of it or putting money into it, which is also when you can adjust the risk levels, right? Because you buy more of what you need more of and less, and don't buy what you need less of. Lars. So I would certainly say for individual investors, they are the kind of things that for sure lose money is a lot of activity in the financial markets.
Lars, thank you for your time today. Thank you for being a guest on Informed Choice Radio. Before you go, how can our listeners find out more about you online? And most importantly, where can they buy a copy of the book? So I did this YouTube channel. So I don't know if you somewhere spell out my surname, but if you just look up my name on YouTube, there's 10 or 11 videos sort of outlining these kind of arguments. So those are available. It's actually been great feedback because they've been kind of popular, but I really enjoy making them actually. So certainly go check those out. My books are all available on Amazon, and I think that's a good place to buy them. And the new one's coming out next month, so I should be pitching that, but I don't actually know exactly when. We'll make sure we put links in the show notes so our listeners can find the books and also find your YouTube channel nice and easily. Thank you for your time. That was great. No, my pleasure. Anytime. A big thank you to Lars for joining me as a guest on Informed Choice Radio today. I thought it was really interesting to hear from a former hedge fund manager who now advocates a much simpler, low-cost approach to investing. What was your favourite part of that conversation? Let me know on Twitter at Martin Bamford or in the comment section in the show notes for this episode, which you can find at icradio.co.uk. That's also where you can find useful links and, of course, a full transcript for this episode. Don't forget also to say a quick thank you to Lars on Twitter. You can find him there at Lars Kroijer. That's LarsKroijer. I would also love your review of Informed Choice Radio on iTunes. Visit icradio.co.uk/iTunes where you can leave us your rating and review. Ratings push us higher up the iTunes charts. That helps us to reach more new listeners. It only takes a moment to leave us a rating and review, and we will, of course, read it out in a future episode. Thank you for listening to this episode, and thank you so much for your continued support of this podcast. Until next time, I'm Martin Bamford, and this is Informed Choice Radio. And remember, when it comes to your money, the more you know, the faster it can grow.